This is the FOMO market, fear of missing out market. Stocks, in fact, the bias we've now seen shifting to the upside. It's clear now the bias to the upside is for a couple of reasons, and people are afraid of missing out. Now, what I will say is that the last two sessions, though, make it clear that the rally lacks that oomph, right? Even as we do have that fear of missing out to the upside, and it's replaced fear of losing everything, market waiting for something to pop, right? Consider that the most important economic data. Right now behind the market, for a while at least, earnings season winding down, and the next jobs report is just weeks away. Coming into this week, 455 S&P names had reported for the quarter, and according to Thompson, both revenue and earnings have crushed it, and particularly historic trends has absolutely killed it. And while it's early, most experts are looking for strong GDP numbers for this quarter, including the Atlanta Fed, which is now calling for 4% growth. I know they can be wildly off, but that's huge, and no one's disputing it's going to be a strong quarter. Now, tomorrow we get the latest on retail sales, which should prove interesting. Remember, last month the number beat consensus, but there's still sort of lingering questions about the state of the U.S. consumer. Consensus estimates see an increase in spending slowing at a slower pace in April. So can the rally pick up steam? And will the catalyst come from a better than expected economic growth, particularly from the consumer? Back with me now, Ryan Payne. All right, so Ryan, the consumer is a wild card because first quarter GDP was weighed down, even though it beat estimates, was weighed down by a consumer that didn't necessarily step up to the plate. We've seen credit card debt decrease 2 months in a row, which is very rare. Yeah. And we've seen savings edge up. I contend, it's my theory, that this is a smarter consumer that lived through the Great Recession and is reluctant to get over his or her skis anymore. Oh, absolutely. I mean, shouldn't we be celebrating the fact that we're not, putting credit cards on debt, buying cars and things like that? But, the conservative or the U.S. consumers become more conservative, which is kind of shocking, but it's happened. So then what does that mean, though? Because they're 2/3 of the economy. I know we always want to have our cake and eat it, too. We want consumers to spend a certain amount. We need them to move that economic needle. We also know that if it's done the right way and we get sort of money flowing through the system, that's the virtual cycle that the Fed thus far was unable to trigger. Yeah, well, I think there's two things. Number one, millennials. You got to remember, millennials now are getting into like mid-30s. They're like 80 million people, and they're finally leaving their parents' basement. They're buying houses, and they're starting families. So that consumer is going to be a very good consumer for a long time because you're in your peak buying years when you have a family, and think about the things you need to buy in your house. When you have kids, they're very expensive. So that's going to be one driver. The other driver that we haven't talked about a lot the last 10 years is companies are now spending money on their business. Capital expenditure is a big part of GDP as well, and I think that's going to really start cooking these next couple of years. Taking advantage of all the new, fewer regulations, lower taxes, things like that. Oh, yeah, absolutely. I mean, we talked about Apple in the other segment, and they're already put like $18 billion back into research and development this year. So, Ryan, we're up 8 sessions in a row, and it's sort of stealthy. No one's taken out the pom-poms just yet, but we are now breaking some of these patterns. A pattern of lower highs, for instance, we've broken through that. There's some key resistance numbers left. Now the question I'm asking everyone is, do you think we're in a position to at the very least, retest the highs from January? I think it's going to happen. I think you could see another big melt up like January if you're not careful here. So if you're not invested right now, I'd be nervous because I think earnings are just going to keep coming in better and better. And if you're sitting with cash right now, it's just going to get even more and more. You're going to feel more and more pressure to get invested. So I'd get there before the herd. This morning I saw Caterpillar get a downgrade to sell and the stock was up. Things like that are telling me, you know what, something's going on. Before I let you go, where do you like? Is there a sector that you like more than others right now? I do. I think energy is coming back in a big way. You're seeing oil prices rise. You look at MLPs, they have yields around 6 or 7%. Definitely a great buy right now. All right, Master Limited Partnerships, Ryan, thank you very much.